Tom Cloud with this week's Precious Metals Market Update. I want to start out by telling you, first of all, this week, the week of February 2nd, you can expect volatility. We're getting a lot of economic news this week with the manufacturing capacities, and also we're getting the non-farm unemployment figures coming out. So if these numbers come out far better than the estimates, you're going to see gold go down on the short term. That's the way it works. If the numbers are worse than they anticipate, then you'll see gold jumping as we get in. These things start coming out on Wednesday with the last one out on Friday. So it's always an effect on gold one way or the other. But once again, it's short term. It's not long term, but it does affect the price if you're looking for an entry point and trying to get in. Capital Economic Advisors came out this weekend and raised their, they were saying when gold started the year at $11.83 per ounce, they thought it would go to $1,300. And of course, we're already been to $1,300. They now feel that that gold will get to at least $1,400, and they have had probably the best, one of the top track records in forecasting the price of gold for the end of the year, not all the volatility in between, the ups and downs and all around. Also this week, we got the figures on the Shanghai Gold Exchange, where they're selling physical gold, as we've talked about many times on this show. But last week was an special 8.5 million ounces of physical gold sold on the Shanghai Gold Exchange. And it should continue to pick up in February as we head toward that February 19th New Year for the Chinese, where they give each other gold bars, ingots, as well as gold jewelry as a good wish present for the year, the coming year. So it's very important as we look. That is going to be, no matter what the unemployment numbers and the manufacturing numbers come in, we know that this is a standard thing every year that's very positive for the gold market. So as we get right in the middle of the market, and that's usually the middle 2 weeks of February, are where we see the most benefit to the price of gold. So may have a downward trend this week followed by an upward trend, but gold continues to be very rare in the physical. There are quite a few articles been out over the last few days in the media, on the internet, talking about the gold shortages, showing you figures of how quickly physical gold could be wiped out. And I certainly agree with that. I also want to talk very briefly about the silver market. Behaved very crazy last week. We've now seen silver start the year at $15.60, has moved up to $17, was up as high as $18 a couple of weeks ago. So we finished the first month of the year with silver up 9.5%. Pretty darn good. But there was some interesting developments last week. We saw the physical buying in ETFs go down, and the long contracts on silver going up for the April, September, December contracts. More people betting on silver increasing, and yet we actually saw the ETFs get less demand for what they call physical gold, silver. But we hope they're just getting educated as you are, that you're buying paper even when you buy an ETF. So silver is going to continue to rock with the economic news. As we see things that look recessionary, it's going to put pressure on silver down. As we see things looking inflationary, or the world's not going to stay in a recession long, not going to be deflationary, then we're going to see silver prices go up. And then palladium is really bound right now, waiting on a clear direction as to what to do. So we're very neutral on palladium right now. That's been our best metal the last 2 years. But right now it stays bound between $750 and $800 an ounce. So there's no hurry to get in if you're not already in. But it is something that you need to watch. If it does break that 800, you need to move in, because we think it will go to 900 per ounce fairly quickly once it breaks that 800 barrier. The last thing I want to talk about is probably the most important, and that is the explosion in the debt in this country. With the new figures out now for the end of the year, and I've got to look at the notes to be sure I tell you exactly right, we've had the total American debt since 1960 to 2000 through 2014 go up from a little over $5 trillion to $57 trillion. And that is in a total of 54 years. What makes this, and this is total debt including federal debt, local government like what you call government bonds, what you call local bonds to finance. These are credit card debts. This is business debt borrowed from banks, and household debt, as I said, your credit card debt. So since 1960, we've seen the income go up, the total income for this country go up 400% in a total of 54 years. Over that same 54 years, the debt's gone up 1,150%. So you've seen it grow at triple the rate of what income has, and that's the reason we're in the problems we are today. People have tried to keep up with the Joneses, buying things they can't afford. Municipalities issue bonds because they need money. They're a credit risk, just like you are when you borrow from the bank. And we're seeing bond defaults, and we're seeing downgrading bonds, and people continuing to roll debt over and add to it. So as we look at this, the most alarming part is in the last 25 years, 81% of this debt has been accumulated. So for the first 19 years, it's 19% of the debt. In the last the first 29 years of the debt makes up 19% of it, and 81% has been in the last 25 years. So can you imagine where there's $57 trillion debt? And I have it graphed. And if you look at it on a graph standpoint, it's almost in a parabolic rise. And do you think that's going to change? Do you think there's any way this is going to go down? Of course not. It's getting worse every single year. With 307 million people in America, including newborns, that comes out to $185,700 per person is where our debt is now, and getting worse every single day. So you've got to realize that gold is going to explode, and we don't know when. I mean, I still think it'll be before Obama leaves office at the end of next year, but central banks are buying gold for safety, and people that think the economy is getting better are buying silver for industrial use. Big manufacturers of people that high definition television and any electronic thing that uses silver. So this is going to continue on and on. Let me look quickly to see if I've mentioned everything I wanted to mention today, and I have. And I do have a talk coming up in Peoria, Illinois on the 28th of February, and I'll be doing a DVD that'll be available at that point that'll cover some of this, plus other things that we're talking about almost weekly. So you need to continue to work toward getting your precious metals portfolio where you want it, why the premiums are as low as they are. And we talked about premiums last week being the cheapest place in the world to buy gold and silver is right here in the USA, and that's going to get worse also. If I can answer any questions, just give us a call at 800-247-2812. That's 800-247-2812. If you're looking at setting up a self-directed precious metals IRA, you can also call and we'll walk you through how you can have a self-directed precious metals IRAs holding physical gold and physical silver. And if there's anything else you'd like to talk about, give us a call. We're happy to go over any questions you might have. Anything pertaining to gold, silver, platinum, palladium, in diamonds. And at some point, we'll be doing a lot more on the diamonds as they continue to be. But we were going to wait to see if Congress does keep the estate tax coming back when they vote, and things that will have drastic effect on diamond prices. And also these tax increases that are headed through the Obamacare bill that go into effect this year in 2015. With this week's Precious Metals Market Update, this is Tom Cloud signing out.